Nobody at the bank is going to tell you this, so I will. The 30-year mortgage isn't a favor. It's the most profitable product a bank has ever invented, and they dressed it up as kindness so well that most people never think to ask who it's actually kind to. I didn't figure this out from a book or a finance channel. I figured it out because of one phone call from a guy I went to high school with, Theo. He'd had his mortgage 6 years. 6 years of payments, never missed one. Did everything he was supposed to do. And one random Tuesday, he actually opened the breakdown of his loan instead of just glancing at the total due, and called me sounding kind of hollow. He said, "I've basically been renting from the bank this whole time. I just didn't know it." That sentence wrecked me a little, because at the time I was about to buy a house myself, and I had zero reason to think my situation would be any different. So when I sat down with my own mortgage officer a few months later, I asked one question that apparently wasn't in her usual flow. What does this loan actually cost me total? Over 30 years? Not the monthly number. The real number. She clicked around for a second, like she wasn't expecting to be asked, and turned the screen toward me. $958,000 on a $400,000 loan. I want you to actually picture that gap for a second, because I had to sit with it myself before it landed. Nearly $560,000 of that is just interest. Not the house, not anything you can touch or sell or live in, just the cost of being allowed to borrow the money in the first place. And here's the thing that made me actually angry instead of just surprised. There was another version of that exact same loan sitting on her screen the whole time, one she never brought up until I asked. A 15-year version of that same $400,000 loan, same interest rate, same lender, comes out to about $647,000 total. Interest paid, roughly $247,000. So put those next to each other. $558,000 in interest on one version, $247,000 on the other. Same house, same bank, same rate. The only difference is which piece of paper you sign. And that difference is worth $311,000. $311,000 for a monthly payment that's about $935 cheaper on the longer loan. Nobody hands you that comparison unless you go digging for it. And I don't think that's an accident, because if every single buyer saw those two numbers side by side before signing, a lot fewer people would pick the one that hands the bank an extra $325,000. And here's what actually gets me about that. Theo isn't unintelligent. I'm not careless. Almost nobody sitting in that chair is. People just trust that the person across the desk, the one with the title, the folder, the calm, reassuring voice, is giving them the full picture, the way you'd trust a doctor to mention the side effects. The system doesn't need anyone to be foolish for it to work. It just needs everyone to assume someone else already checked the math on their behalf. And almost nobody has. That's not a personal failure. That's a design choice on someone else's part. And it works precisely because it looks like nothing is being hidden at all. So here's a question that genuinely bothered me for weeks after that meeting. Why does the 30-year mortgage even exist as the default? Who decided this was just the normal way to buy a house? And why does almost nobody question it? Turns out the answer is kind of wild, and it didn't start as a scam at all. Before the 1930s, mortgages in America were brutal. 5 to 10-year terms, balloon payments at the end that could wipe you out overnight, down payments around 50%. Basically, if you weren't already wealthy, you weren't buying a house. The Great Depression blew that whole system up, and the government created the FHA specifically to fix it, to make homeownership reachable for regular working families. Longer terms were part of the actual solution, genuinely well-intentioned. But somewhere between then and now, that good idea got absorbed into something a lot more profitable for everybody except the homeowner. Because here's the thing about interest. It doesn't just sit there, it compounds. And the longer you stretch a loan out, the more interest mathematically exists to collect. 20 years became 30. 30 became the default. What started as access for the average family quietly became the most lucrative structure a bank could legally offer. And then, this is the part that genuinely changed how I see the entire industry. Starting in the 70s, accelerating hard through the 80s, banks stopped just sitting on these loans and collecting payments slowly for 30 years. They started bundling thousands of them together into something called mortgage-backed securities and selling those bundles straight to investors. The bank gets a big lump sum up front. The investor gets your decades of interest. And the longer the loan term baked into that bundle, the more interest income exists inside it to sell. Now, if you remember anything about 2008, you already know exactly where this story goes next, because that same system, banks bundling mortgages and selling them off as investment products, is the machinery that collapsed the entire global economy less than 2 decades ago. Lenders had gotten so comfortable selling off their loans to investors that a lot of them stopped caring whether the people taking out those mortgages could actually pay them back. Why would they? They weren't holding the risk anymore. They'd already sold it, bundled it, shipped it 3 steps removed from the actual house, sometimes to a pension fund holding someone's retirement on the other end. And when millions of those underlying loans started failing at once, the entire structure built on top of them came down with it. Banks collapsed. Retirement retirement accounts evaporated overnight. People who had nothing to do with any of this lost their jobs, their savings, sometimes their own homes, because of a system built around exactly the loan structure you might be holding right now. I'm not telling you this to scare you into thinking your mortgage is about to cause the next crash. I'm telling you because the same incentive that nearly broke the entire global economy in 2008 is still the quiet incentive sitting underneath the offer you get handed at the bank today. Sell the loan, stretch the term, maximize the interest, move the risk somewhere else fast before anyone has to live with the consequences of it. That machinery didn't disappear after 2008. It got a few more regulations bolted onto it. It never got dismantled. So the 30-year mortgage isn't just a loan anymore. It's a product, packaged, rated, sold on Wall Street to investors who like it specifically because it pays out slowly and predictably for 30 whole years. Your slow progress isn't a flaw in the system. It's the feature somebody else is buying. This is exactly what was happening to Theo, by the way, even though he had no idea that's what it was. In year one of a loan like his, roughly $27,800 goes to interest. About $5,000 actually touches the principal. You're paying down the bank's profit 5 times faster than your own house. And that doesn't really shift until somewhere around year 15 or 16. So for over a decade, more than a decade, you can do everything right, pay every bill on time, and still be building almost nothing because the schedule was built that way on purpose. 6 years in, Theo had barely moved the needle. Not because he did anything wrong, because the math was never designed to move for him that early. I want to give you the version of this story that almost never makes it into a video like this though, because it matters just as much. Theo's older sister bought her house the same year he did. Different lender, similar loan size, but she'd had a coworker years earlier tell her about extra principal payments, almost in passing the same way Theo eventually told me. She started adding $200 a month from day one without ever telling anyone, just quietly building it into her budget like any other bill. 6 years in, when Theo called me sounding hollow, she had already cut nearly 4 years off her own loan without ever feeling like she was sacrificing anything. Same bank, same neighborhood, same starting point. The only difference between her outcome and her brother's was one piece of information that happened to reach her and almost didn't reach him. That's the part that actually unsettles me the most about this whole system. It's not that the bank is lying to anyone outright, it's that the entire outcome of a 30-year financial decision can hinge on whether or not you happen to have a coworker, a friend, a cousin, anyone who mentioned one specific detail to you at the right moment. Wealth in a system like this isn't just about discipline or income. It's about who you happen to know and what they happened to mention to you once, almost by accident. Now, and I want to be honest here instead of just riding the outrage, it's not quite as simple as 30-year mortgages are evil, never get one. For a lot of people, that lower payment is the actual difference between qualifying for a home and not qualifying at all. It's breathing room. Kids get sick, cars break down, jobs get unstable. A 15-year payment that leaves zero cushion can absolutely blow up in your face just as badly as the interest trap we just walked through. The problem isn't that the option exists. The problem is that it's handed to you as the obvious responsible choice, with nobody ever showing you what it actually costs, and nobody telling you that you're allowed to fight back against that structure without locking yourself into a rigid higher payment. Here's what I told Theo, and what I'd tell you if you were sitting across from me right now instead of watching this. Keep the 30-year loan for the flexibility if you need it, but attack it like it's shorter whenever you actually can. On that same $400,000 loan, adding an extra $300 a month toward principal, nothing dramatic, knocks the term down to about 22 years and saves roughly $140,000 in interest. Push it to $500 extra, and you're looking at 18 years, closer to $200,000 saved. You keep the safety net for the rough months. You still got most of the interest the bank was counting on collecting from you. Or switch to bi-weekly payments instead of monthly. Half your payment every 2 weeks instead of the full thing once a month. Because of how the calendar lands, that quietly turns into 13 monthly payments a year instead of 12. One extra payment, almost invisible to your budget, that alone can knock 4 to 6 years off the loan. There's a third option that almost nobody talks about, and it costs absolutely nothing to set up. Most lenders let you make a single lump sum payment toward principal whenever you have extra cash, a tax refund, a bonus, a side project that paid off, without any penalty at all. People treat that windfall money like spending money because it feels like a bonus, like found money that's separate from the rest of their finances. But $1,500 thrown at principal in year 3 of a loan like ours does more work, dollar for dollar, than the exact same $1,500 thrown at principal in year 20, simply because of how much more interest is still compounding against you early on. Timing matters as much as the amount. Theo started with an extra $250 a month the very next paycheck. 18 months later, he called me again. Completely different energy this time. Said it was the first time the house actually felt like his instead of the bank's. And I want you to actually sit with that $311,000 difference for a second longer before we wrap up, because a number that size is easy to read past without feeling it. If you took that exact amount, the gap between the two loans, and instead of handing it to a bank slowly over 30 years, you put it into a simple investment account. Over that same period, averaging a normal 7% return, you wouldn't just be saving it. You'd be looking at well over $500,000 in real liquid wealth by the time that mortgage would have ended anyway. Same 30 years, same house, completely different ending for your bank account, decided entirely by which piece of paper you signed on one Tuesday afternoon, at a desk you probably don't even remember the color of anymore. Here's something else worth sitting with before you go. A mortgage is one of the only major financial decisions most people make exactly once, maybe twice in their entire life. You don't get to practice it. You don't get a few attempts to get a feel for how it works before the real one counts. Most of us walk into that room having researched the house exhaustively, the neighborhood, the school district, the resale value, the inspection report, and then sign the actual loan itself based on nothing but trust in whoever happens to be sitting across the desk that day. We do more homework on the thing we're buying than on the thing we're borrowing to buy it. That gap is exactly where this entire system lives and quietly profits. Not in anything illegal, not in anything anyone could be sued for, just in that one specific blind spot, repeated across millions of kitchen tables and bank offices every single year, generation after generation, mostly because nobody before us thought to ask the question either, so nobody passed it down. So here's the actual point of all this. The 30-year mortgage was never built to be generous to you. It was built to be generous to whoever was holding the other end of the loan. And somewhere along the way, that got rebranded as responsible so thoroughly that almost nobody questions it anymore. That doesn't mean don't take one. It means stop assuming the default option is the kind option. It's not. It's just the most profitable one for someone who, this week, go check whether your loan allows extra principal payments with no penalty. Most do. And run the math on what even $100 or $200 extra a month would save you. Takes about 5 minutes on any free calculator online. If you haven't bought yet, ask for the 15-year number in writing before you ever sign anything and actually sit with what that lower monthly payment is really costing you. The bank built this thing to work for them first. Theo's sister figured out how to make it work for her instead, almost by accident. Now you know exactly how to do it on purpose.